I'm really excited for today's video because in today's video, we're going to take the guesswork out of investing. I find with a lot of people when it comes to investing, they just freeze up because they don't know where to put their money and they don't know who to ask, and so they do nothing. So in today's video, we're going to break down how we would invest $1,000 over 3 ETFs that will create a simple but diversified portfolio. Okay, so just a quick note, this is not financial advice. I'm just showing you how I would invest $1,000, but this is a jumping off point for you on your journey, and you need to do your own research. Okay, so what is an ETF? ETF stands for Exchange Traded Fund. It might sound fancy or confusing, but really all it is a basket of stocks, all put together in one fund. And here's why ETFs are so powerful. They're cheap. The expense ratio might be something like 0.03 to 0.05. I think all the ones that we're talking about today are in that range. So that means that on a $10,000 investment, it costs you $30 a year. And the other reason these ETFs make such a great investment is accessibility, because you can buy fractional shares. You can start investing with as little as $1. You don't have to wait. Okay, let's put that $1,000 to work. I'd start with $500, half of it, and I'd put that in VTI. That's Vanguard's Total Stock Market ETF. Now here's why VTI. VTI is the ultimate diversification. You're not just getting the big names like Apple and Amazon. You're also getting thousands of mid-sized companies and even small ones. You're getting over 3,000 companies in VTI. And here's something a lot of people don't realize. VTI updates itself. If a company falls behind, it eventually gets dropped. If a new innovative company rises up, it gets added in. You're always holding the current leaders of the U.S. economy. When you invest in VTI, you're investing in the U.S. economy. For our next ETF, $300, 30% is going into VGT. VGT is Vanguard's Information Technology Fund. This fund leans into the big innovators, companies like Apple, Microsoft, Nvidia, Meta. It's riskier than VTI, but it has serious growth potential. Now, here's what I have to say about that. The technology stocks are volatile, so you have to be able to stomach that volatility, and you have to have time. If you're looking at a year or two, forget about this one. But I'm looking out 10 years from now. So I'm not going to touch this for at least 10 years. And if you think about innovation in AI, in drones, in flying transportation, technology is not going to be on the decline, and it's not stopping. So one thing you have to think about is even if our stocks go down for a little bit, they're not going to stop putting money into innovation. These companies have so much money to invest in innovation that technology from 10 years from now, we're not even going to recognize it. So I'm not telling you to invest in this fund, but find yourself a technology fund that you want to invest in if you have a 10-year time horizon. If it's 1 to 2 years, I would say forget this. We don't know what's going to happen in the next year or two, but 10 years from now, life's going to be different. And with the last $200, we're going to try to do like a little balance on that potential volatility of VGT, and we're going to go with something that's a lot more stable, and that is VIG or VYM, and these are Vanguard's dividend funds. Now, VIG is a lower dividend yield than VYM. So VYM would be a little bit riskier. So I would say do your own research, look at your time horizon, and decide which way you want to go. There are a lot of great sites where you can compare two ETFs to see how do they compare in expense ratio? What are the holdings in each one? What are the dividend yields? So for me, I'm going with VYM because I'm a risk taker. So VYM is my choice, but I think you can't go wrong with either one of these funds, VIG or VYM. Let me know in the comments which one you like more, VIG or VYM, and let me know why. Okay, so let's recap. $500 in VTI for the foundation, $300 in VGT for growth, and $200 in VIG or VYM for dividends. And also it balances out the VGT. And I've noticed this past year in my own Roth, where I hold a lot of dividend stocks and funds, that when my technology stocks take a big hit, my dividend stocks are holding steady beautifully. So I never have a massive drop in my account. So this strategy has been working over the last year, and it's definitely been keeping me calm. But I'd like to know what you think. What do you think about this strategy? Is it something you'd look into? And I also just want to say, this isn't a Vanguard ad. I'm not paid by Vanguard. I've had my account at Vanguard for over 20 years, so that's where I am, and so that's what I do. But you can find equivalent ETFs to these at Fidelity and Schwab or wherever you have your brokerage accounts. So the big question is, if you had $1,000 to invest, how would you split it up? Share your breakdown in the comments. My name's Carrie. This is Middle Money and More. I totally appreciate you being here. If you got anything out of this today, would you please give it a thumbs up and consider subscribing to the channel? Your participation in this channel helps the YouTube algorithm push it out to other people, and I really appreciate that so much, as well as I appreciate you being here more than you know, and I'll see you in the next one. Bye!